I believe that. Sorry about that. Thank you all for joining the Financial Accountability and Corporate Transparency, or FAT Coalition, for what promises to be an excellent conversation today, tying together a confluence of tax policy happenings in the US and internationally. As many of you are aware, today the Tax Justice Network, in collaboration with the Global Alliance for Tax Justice and Public Services International, released its State of Tax Justice report for 2021. We will discuss the report's findings in greater detail later in the panel, but among other key points, the 2021 State of Tax Justice report shows that the tax avoidance by multinational corporations and wealthy individuals could result in governments around the world losing nearly $5 trillion over the next decade. Among the biggest losers, the US government. However, as the report shows, the US is by no means blameless. This report comes on the heels of the Pandora Papers, the most expansive journalistic expose to date, highlighting the ways that criminals and the global elite avoid taxes and public accountability through an offshore system that, as it happens, isn't so offshore as the name might suggest. Sandwiched between the State of Tax Justice report and the Pandora Papers, another not so insignificant thing occurred. A historic international agreement was adopted to create a global minimum corporate tax. Furthered by President Biden through the OECD, a two-pillar solution reallocates taxing rights for the largest multinational enterprises to market jurisdictions and sets a global minimum rate of tax for large multinational profits at 15%. As we speak, Congress is debating reforms that would partially implement the OECD agreement. And these reforms explicitly target profit shifting, but they are just one piece of the puzzle in addressing the grand scale of tax fraud. It's safe to say that a lot is happening. So we're here to discuss a $5 trillion problem, why it matters, and the potentially less glitzy tax transparency and tax evasion tools that are necessary to more comprehensively address this problem in the US and across the globe. And we are joined by a fantastic set of panelists, beginning with Senator Chris Van Hollen, who will give introductory remarks and participate in a brief Q&A before we transition to our friends at the Tax Justice Network and Eurodad for further discussion. Senator Van Hollen is known for leading the fights for greater tax transparency, such as through sponsoring the Disclosure of Tax Havens and Offshoring Act, and for ensuring that tax authorities are properly funded and have the right tools and information to get the job done. Senator Van Hollen, thanks for joining us today.
Well, thank you, Ryan, and thank you for your work. And I want to salute the work of you and the entire FACT Coalition family. And thank you for hosting today's gathering on tax transparency. And I'm pleased to be joined by two members from my team, Harry Stein and Demi Liu, who work on these issues as well. And we've worked together with the FACT Coalition earlier this year. I was on with your executive director, Ian Gary, where we spoke to businesses, especially smaller and mid-sized domestic US businesses, about the bill that I've introduced, the Disclosure of Tax Havens and Offshoring Act. And they were interested in it because those smaller and medium-sized businesses and domestically focused corporations are put at a huge disadvantage by both our current multinational and international tax regime, as well as the issue of non-compliance that you referenced, Ryan. So I want to thank you. I want to thank the Tax Justice Network for joining us and for assembling the State of Tax Justice report for 2021, which, is Ryan just indicated, shows that if we don't do something about it, countries will lose trillions and trillions of dollars to tax avoidance, funds that could be invested to help them and their people succeed. If you look at the US tax code in its current state, it's essentially hardwired to support the very, very wealthy and to provide ways for corporations to avoid paying their fair share. And of course, the Trump 2017 tax giveaway made those laws even worse in many respects, and has allowed corporations to park their profits overseas in tax havens and shield their revenues. Just to give you one data point, in 2018, US companies booked $105 billion worth of profits in Bermuda. I think we all know that they don't have any kind of plant and equipment there that would justify that kind of profit number. So clearly just a transfer on paper and tax avoidance schemes. And that has resulted obviously in shortchanging investments that the United States and other countries can make in strengthening their countries, their infrastructure, and making those important investments. So that's what brings us to the Build Back Better bill, as well as the transparency legislation that I've introduced. On the Build Back Better front, the good news is that we are working to apply a 15% minimum worldwide tax on a country by country basis, which is designed to address many of the loopholes that were created by the Trump tax giveaway. And of course, the President and Secretary Yellen have been working to try to get that 15% minimum tax established as an international agreement, especially among the most developed countries, with the goal of taking it worldwide. And that will be really important. But it's also essential that we get the transparency piece right, because otherwise corporations can continue to try to evade their responsibilities and hide their money. And that is why releasing information regarding corporate profits on a country by country basis is so important. And that is why we introduced the legislation that we did, the Disclosure of Tax Havens and Offshoring Act. That will help shine a spotlight on hidden competitive advantages that large multinational corporations have under our tax code. It will collect data to help guide future corporate tax policy, and it will provide transparency to investors. And we've already seen from some of the Act's disclosure requirements taken in the EU that this can have a positive effect in terms of the conduct of some of these corporations. So our bill would also, and I want to make this clear, would not add any additional burdensome reporting requirements for the multinational corporations that are covered by our proposal. It simply requires that basic financial information like profits, taxes, and the number of employees be provided for each country in which the corporation operates. And currently corporations with annual revenues above 850 million report this information to the IRS under an international agreement framework negotiated by the OECD. So for these corporations above that, with revenues above that threshold, they already have to report this information. It's a matter of making it public and the benefits of the sunshine that come with that. So we also think this is a win for investors because there is reputational and other risks from some of these tax avoidance schemes that are being used by these corporations. As Ryan mentioned, the Pandora Papers have exposed a number of games that people play, including how trusts are abused by extremely wealthy individuals to hide their wealth. And I've teamed up with some of my colleagues to propose another piece of legislation on that front. We have a detailed white paper now. We're continuing to seek comment, including from any folks on this call. But I introduced a bill with a proposal with Senators Booker, Sanders, Whitehouse, and Warren. It's called the STEP Act, which would provide for to close the stepped-up basis loophole. One provision of that bill, of that proposal, I should say, which will soon be a bill, requires a large trust to report basic information to the IRS, which trusts are not currently reporting. And that has increased urgency in light of the revelations from the Pandora Papers that we've seen. Finally, as part of the Build Back Better effort, we hope to give the IRS the tools that they need to both improve customer service, but also crack down on those who are not paying their share of taxes, which primarily are folks who get the bulk of their income not through wages, but through other ways of generating income. And that's why the bill proposes to provide $80 billion to the IRS to generate, to close the loopholes. And we estimate, or I should say the Biden administration estimates, that will generate $400 billion in revenue over the next 10 years. Again, revenue that's already due and owing, but has not been collected due to insufficient enforcement tools and resources at the IRS. I chair the Appropriations Subcommittee that oversees the IRS. We had a hearing on this, including hearing from the current IRS commissioner, who recently wrote an op-ed as well on the importance of getting these resources to collect these taxes that are due and owing but unpaid. So let me close there, Ryan, and just close where I started, which is thanking all of you for coming together, for doing the important work in terms of gathering information and analysis, and then advocacy, so that we can develop a fair income tax system and tax system for the United States and others around the world. So good to be with you.
Thank you so much, Senator Van Hollen. And we do have a few moments, I think, for Q&A, and I'll just ask the audience to put their Q&A in the chat. While we let them get started, I thought maybe I can get one question going here. Senator Van Hollen, you've been very vocally supportive of increased IRS funding, as you just closed with. Can you speak to why IRS funding now is such an important part of Build Back Better, both as it relates to the concerns of working families and the other technical tax reforms that are a part of the package?
Yes, the testimony we've received from IRS commissioners, from appointed by presidents from both political parties, has been consistent over time, which is they are simply under-resourced when it comes to being able to hire folks who can do the necessary work and put in the time to track down taxes owed by people who can use very creative means to avoid paying their taxes that are due. And that's why we see these estimates of huge sums of money that can be collected without changing a single provision of U.S. tax law. So we've got to move forward on this, because we've also seen something else, which is while the IRS has been underfunded for years, the impact of their enforcement has fallen harder on lower income individuals than higher income individuals. And for example, if you look at their audits of folks on EITC, their audits on those accounts, are less, have been reduced by less than the audits. The audits on those accounts remain in place, whereas the audits on the higher income individuals and corporations have been diminished and reduced, and that's simply because it's easier to sort of run a computer program or put a lot of people on returns related to wages, where there's more information. But the whole point of this legislation is to make sure that the IRS now has the resources to hire up, both in terms of people power as well as expertise, to go for where the money really is, right? I mean, as Willie Sutton said, you really need to go where the money is, and we need to make sure the IRS have those powers again to collect what's already due and owing.
Do you have time for one more question?
Sure.
Excellent. Last week was a rare instance for bipartisanship in the U.S. Congress with the passage of the Bipartisan Infrastructure Bill. Can you talk about the path forward for the disclosure of tax havens and offshoring act? including whether you might be interested in supporting the SEC, which might have jurisdiction to advance those rules separately from the legislation itself.
Sure. Yes, it was good to be at the White House yesterday for the bill signing ceremony of the infrastructure modernization plan. Very important investments being made there. We're working to try to get greater bipartisan support for this bill to simply require greater disclosure. You would think or hope that that was a nonpartisan issue, getting big corporations to simply, tell the truth about where they're parking their funds. But despite our efforts, we still don't have, bipartisan co-sponsorship of the bill. We'll continue our efforts, and anything that you or others on this call can do to encourage Republican support for that would be great. And so we will continue down that path. But we also want to, and I also support having the SEC undertake a rulemaking on their existing authority to require these disclosures. They have the authority. It's just a question of whether they want to exercise it. And we're going to continue to sort of work this on both tracks, both the legislative track, but also really encourage the SEC to move in this direction. They've obviously got a lot on their plate, as does the Congress. But this would be, I think, an important move, and certainly within their jurisdiction, because investors, it seems to me, should have this kind of information, and obviously it also serves a public purpose.
Thank you so much, Senator Van Hollen, for your time and your leadership. I know you're very busy, so we are really appreciative, and we'll let you get back to leading on these very efforts.
Well, thank you. Thank you for all the work that you and the FACT Coalition are doing, and look forward to any recommendations that come out of the discussion today. Take care.
Thank you. Okay, moving into our next portion of the panel, we're now going to get a little bit more into the details of the State of Tax Justice Report 2021 and its implications internationally and for U.S. policy, in addition to what we just spoke about, obviously, with Senator Van Hollen, as the ties between tax transparency and the report's findings are tantamount. So we're going to start with a discussion with Alex Cobbin. Alex is an economist and the chief executive of the Tax Justice Network, which led a consortium of institutional authors for the State of Tax Justice Report. There, his work focuses on illicit financial flows, effective taxation for development and inequality. And Alex, we're just hoping, can you please tell us about the findings in this year's State of Tax Justice Report and why now is such a critical time to pursue the ABCs of tax transparency?
Sure. Thanks, Ryan, and thank you to the FACT Coalition for organising this webinar. Look, this is the second year that we've done this report at Tax Justice Network, but with Public Services International, one of the global union federations, and with the Global Alliance for Tax Justice, who are the umbrella body for mass mobilisation organisations on tax justice. So we've come together to put what is now for the second time what we think are the best possible estimates of the tax losses that are suffered due to cross-border tax abuse. That's tax abuse by multinational companies and by individuals hiding assets and income streams offshore. And this year, the findings, the top line really is that globally, we think, and this is a conservative estimate deliberately, that the tax losses suffered are $483 billion a year, of which 312 billion are due to the tax abuse of multinational companies and 171 billion due to the tax abuse of individuals holding assets and income streams offshore. Now, for the US losses are about 113 billion, so the biggest single loser is the United States itself. But the analysis also allows us to look at which countries and jurisdictions are imposing losses on others. And there we also see the United States imposing losses not on the corporate side, but on the offshore side of perhaps $20 billion on people in other countries. And that's because of the financial secrecy that the US offers to people bringing assets and income from elsewhere. So there's a set of issues there where, there really is a win-win. The US can protect itself and raise significant additional revenues. At the same time, it can really reduce the extent to which it's imposing revenue losses on other countries. And it's very, very welcoming to hear Senator Van Hollen talk about some of those measures, including, as you say, Ryan, the ABC. This is a policy platform we put together in the early mid-2000s, and it's seen a lot of progress after initially being written off as utopian and completely unrealistic, but there's still a long way to go. So A is for the automatic exchange of financial account information. That's really so that a country, whether it's Switzerland or the United States, is telling the tax authority of other countries the size of financial accounts that their tax residents have, so that information needs to be consistent with what taxpayers are telling their own tax authority, and we close the gap on the bit that's being hidden. Then B is for beneficial ownership transparency, and that's making sure that we have public registers of who are the ultimate warm-blooded human beings behind every legal vehicle, so every company, every trust, foundation and partnership, because we know that markets don't work as well when people can hide who they are and what they're doing, and nor do states when people can dodge their tax responsibilities. And then C, well, I think Tova will talk about C, but C is for public country-by-country reporting by multinational companies, really just to put multinationals on some kind of a level playing field with domestic businesses that publish their accounts and are almost by definition significantly more transparent than a multinational company that only publishes consolidated accounts.
Thank you, Alex. And I think we'll now have Tove speak a little bit more on country-by-country reporting before we go to the question and answer part of the panel. But folks can feel free to start putting their questions for Alex and Tove in the chat, and we'll wrap up with the question part of the panel. Our next panelist is Tove Maria Riding. Tove is the Policy and Advocacy Manager for Eurodad, the European Network on Debt and Development, where she leads work on tax and transparency and carries out coordination, advocacy, and communications work, as well as research and analysis. Tove is also one of 2 elected representatives of the Tax Justice Europe to the coordinating committee of the Global Alliance for Tax Justice. Tove, a lot of news last week from the EU about one particular aspect, as Alex mentioned, of tax transparency, and that's public country-by-country reporting, exactly what Senator Van Hollen was talking about in the Disclosure of Tax Havens and Offshoring Act for the US. Do you mind filling us in on what happened last week and highlighting its broader implications?
Sure, and thank you so much for the invitation and for the great intervention so far. Yeah, country-by-country reporting, in essence, the question about whether citizens should be allowed to see where multinational corporations are doing business and how much tax they pay in each of those countries. This is a discussion that's been going on for a while at the EU level, and what we saw last week was the adoption of a new directive on this issue. The first thing to note is that we actually already have public country-by-country reporting in the EU, but it only covers banks. It was introduced in 2013. And of course, the reason it focused on banks was very much because it came in the context of the financial crisis that we had back then. And already in 2013, the EU started discussing, well, shouldn't this transparency cover all sectors? And at that time, the OECD discussion started. So this was a discussion that was led by the OECD, but included also the G20. And that led to the adoption of a standard on secret country-by-country reporting. So the secret exchange of information between tax authorities, which is something quite different compared to public information. We then had a few years where the EU was discussing whether or not it was okay to go beyond the OECD standard and whether the OECD standard should be seen as you want as the ceiling or as the floor. And I think the first thing to say about the adoption last week was that it's very clear that the EU has now decided the OECD standard is the starting point, but we should definitely look at going further than the OECD standard. So unfortunately, what the EU has adopted is not full country-by-country reporting for all companies and sectors and countries, because on the last point, although the directive covers all sectors, it was actually decided that the numbers should only be published for some countries and not for others. And so we'll get a very incomplete picture. And unfortunately, we actually have over 75% of the countries in the world that are not included. So we'll get data for under 25% of the world's countries. We'll get data for EU member states and for countries that are blacklisted by the EU as non-cooperative on tax matters. But we still need to get the rest of the numbers. And I think that is the last point to stress, is that this is by no means the end of the discussion in the EU. We saw that last week when the directive was adopted, we already had a group in the European Parliament put forward proposals for amendments to plug these big gaps and give us the missing data so that we get the full picture of what multinational corporations are doing. That proposal was not adopted last week, but the debate is still very much going on. And of course, in the context of the current crisis, we expect this to be a very, very big issue going forward because all countries are looking for extra tax income. And we've seen the public country-by-country reporting can help put a spotlight on the countries and jurisdictions that are helping corporations dodge tax.
Thank you, Toby. When we talk about this $5 trillion problem, before we get to Q&A, a few policy points become apparent in the US. First, US international tax reforms in the Build Back Better Act that partially implement the OECD minimum tax agreement must pass to begin dismantling the US tax code's incentives for profit shifting, which is the process through which multinationals move profits from one jurisdiction to another to avoid taxes. Second, the US was an early leader in automatic exchange of information under the Foreign Account Taxpayer Compliance Act, or FATCA, but it hasn't kept up with best practices. By failing to join the OECD's common reporting standard, the US has positioned itself as a financial secrecy jurisdiction, which we know from the good work at Tax Justice Network. That hardly jives with the president's stated fight against illicit financial flows. It's time for the US to join the CRS and to work to improve it, to better the information that's shared among competent authorities globally. Moving on, the Corporate Transparency Act requires corporations, LLCs, and similar entities to disclose their true beneficial owners upon formation or in connection with registering to do business in the US, which can begin to end the anonymity practices relied on by criminals and wealthy individuals to avoid taxes and public accountability, as was highlighted by the Pandora Papers. Forthcoming rules should carry out the law's broad intention, and this beneficial ownership information should be readily available to the IRS pursuant to the law's plain language. Additionally, portions of the senator's stepped proposal that we were spoken about earlier can end perverse secrecy benefits available to trusts and other entities that may seek to avoid government filings. Without these reforms, the US will continue not just to be a victim of tax avoidance, but rather to actively enable tax avoidance, as well as corruption, consistent with the Pandora Papers and the State of Tax Justice findings. And finally, the Disclosure of Tax Havens and Offshoring Act, requiring public country-by-country reporting in the US, discussed by the senator and consistent with Tobe's discussion of how to improve the EU's overall position, should be prioritized. Right now, investors are in the dark regarding risky tax strategies that might inappropriately attract capital, and policymakers are left speculating as to whether our international tax laws work as intended. These reforms are made even more important in light of the OECD Global Minimum Tax Deal and proposed Build Back Better reforms, such as which require the application of the global minimum corporate tax, such as the Global Intangible Low Tax Income Tax here in the US, or the GILTI, to apply on a country-by-country basis. At the same time, the Congress is also currently considering a separate minimum corporate tax that would, among other things, take into account international taxes paid on accounting records. The intersection of these two different minimum taxes, one applying on a country-by-country standard, one explicitly rooted in financial accounting, requires more tax transparency in public accounting for investors and policymakers with respect to large multinational corporations. So the Senate should move to forward the Disclosure of Tax Havens and Offshoring Act on a bipartisan basis. It shouldn't be a partisan issue, but in the event that they are unable to do so, as the senator mentioned, the SEC or the Financial Accounting Standard Board could require this information be made public. And that would position the US as a leader in the world on this. Investors with over 2.9 trillion in assets under management have called for these reforms to be passed, and they should be prioritized. I believe that's kind of sort of the US tax policy takeaways from the report and from Tobe's update. But I think there are still definitely some questions, and I know we have some that have come in from the chat, but I encourage others to ask. Do you both have some time for questions, Alex and Tobe? Excellent. Alex, the 2021 State of Tax Justice highlights again the dramatic tax losses being suffered each year by the US and other nations as a result of tax avoidance, and that the US helps contribute to make for other nations. Can you elaborate on the ways that wealthy nations like the US contribute to tax avoidance and what any of this has to do with the Pandora Papers and similar exposés?
Sure. Thanks, Ryan. So there's a couple of elements in there, as I say, the corporate tax abuse and the individual tax abuse. And the role of the US is quite different in each of those. So when we look at the tax behavior of multinational companies, in a sense, the US is as the headquarters country for the biggest number of the biggest multinationals. The US has played a role over the years of, in a sense, at the same time, although the balance has shifted between these two, wanting to get its fair share of revenues itself, but also being quite open to the idea that it could or should even protect its multinationals from paying a fair share of tax elsewhere. And that's led to all sorts of kind of unnecessary complications and loopholes in the US tax system, including moments of encouraging migration to Bermuda, for example, that really have undermined the US itself as well as others. It's why, if you look at the data, you see in the early 1990s, if you look at the share of the profits of US multinationals that were not being declared in the place where their real economic activity took place, it's only about 5%. But roll forward 20 years to the early 2010s, and suddenly it's exploded to 25, 30% of their global profits, and it's kept rising. So it's become a problem for the US itself as well as others, and that's led the US to be a much more progressive actor, I would say, in international negotiations, but still motivated primarily by its own revenues, and sometimes that leads it to resist measures that would be fairer for others. On the individual side, I think there's a clearer case that the US has really been an obstacle. What you see is, after bringing forward FATCA to ensure that the US will receive information about US taxpayers or tax residents' financial accounts elsewhere, the US initially agreed for about 6 months that it would cooperate and provide the same information to others under the OECD Common Reporting Standard. And then it did a U-turn, since when it has provided almost no information to any other country. And what's happened in that period? Well, of course, the US has become by far and away the most attractive financial center for anyone who wants their financial accounts not to be reported back to their own tax authority. And that's probably had some marginal economic benefit for the US, but really trivial compared to the losses it's imposed elsewhere. And I don't think that's a big part of the US economic model. So seeing the US become fully cooperative in the Common Reporting Standard would be a valuable step. Perhaps just on the CRS, I might pick up a question from the Q&A, because it's a good question. It says, why don't we look at the effect of the Common Reporting Standard in the estimate we do of offshore tax abuse? The answer actually is that we do. The Common Reporting Standard leads you to this great period of automatic exchange that we've campaigned for from when we were set up in 2003, but it isn't the answer to everything. The data are also delayed. So what you see this year compared to last year, it's really the first full year for which the data in state of tax justice reflects the majority of the degree of information now being exchanged under the common reporting standard. And you do see a small drop in the estimate of tax loss from, I think it's 182 billion to 171 billion. But at the moment, the standard has so many holes and it covers such a narrow range of financial accounts that you wouldn't expect an enormous impact, even though something like $10 trillion of assets are now covered. The actual impact on the marginal tax abuse is relatively small. We need to see lower income countries brought in. We need to see the US join in. We need to see countries like Switzerland and others providing that information across the board, not just to some countries that they favor. And we need to see a concerted effort to take on the kind of the Swiss banking and insurance efforts to undermine the standard by creating other assets that look like financial accounts but are not technically reportable. Once we have all of that in place, you'll see a much bigger drop in that number. At the moment, as I say, it is in the analysis, but it's had a relatively small impact as far as the data tell us.
Thank you, Alex. That was tremendously helpful, I think. Tove, as you mentioned, the public country-by-country reporting standards passed were formally adopted last week in the EU, but they have not been heralded as a universal success. What do you think is the path forward for these reforms, either as a catalyst for stronger reform or tax transparency measures generally, and why might US policy be important for these efforts in the EU or otherwise?
Yeah, thank you. Yeah, I think that's an important question. What happens now? We've seen on other areas of tax transparency that the EU first recognizes the problem and then fails to walk the talk, and then quickly reopens the directive again and gives it a second shot and performs better. And we actually saw that on the issue of beneficial ownership, which is a transparent register showing who owns the companies that are operating in the EU. There, they had a first shot at it in what was the fourth anti-money laundering directive, where they adopted something that looked like transparency but wasn't. And then actually very shortly after the directive was adopted, the political pressure continued because the attempt to tick this box as a job done failed. There was simply too much public awareness about the fact that this wasn't the real thing. And so it was reopened again shortly after, and that's actually the reason why today in EU member states, they're all now obliged to introduce public registers of the owners of companies. So the debate that's going on public country-by-country reporting in the EU is a very important sign that this was not the end. And in fact, it's very important that we now have the recognition from the EU that public country-by-country reporting is a good thing. And it's very important that we're moving on from seeing the OECD standard as the end of the story. So now we acknowledge that we need an EU directive on public country-by-country reporting. And that's a good platform to continue pursuing the job of actually getting it done. But the role of the US is extremely important. Linking back to Alex's point about FATCA, looking at this from the EU perspective, we have a lot of countries in the EU that have pursued a career in financial secrecy and offered the banking secrecy in multiple ways. And it's extremely difficult to, I have to say, to campaign on financial transparency and on automatic information exchange in the EU when the EU member states can make the point that, well, but people are just going to move their secret bank accounts to the United States because the United States has managed to get a system set up internationally whereby other countries commit to exchanging information automatically to the US, but they don't get anything back. Furthermore, a key problem with this international system is that it's not very automatic because it still relies on bilateral agreements between countries. So once you have a bilateral deal with a country, then you get the information automatically, but there's a big hurdle in actually getting that deal. That means that the information is going to start flowing. And that's where we saw most of the world's developing countries not being able to make that hurdle. So it's a very half implemented system. And the fact that the US on the one hand says we want information automatically, but then says we're not going to send it back, it becomes a problem politically for the rest of the world. But if we flip that argument on its head, we've also seen again and again that once the United States starts pursuing something such as automatic information exchange or minimum effective corporate tax rates, it really becomes a kick for the discussion in the rest of the world. So it's been very good conversation starters. It's just very important that we don't stop the debate before we actually have effective tools and laws in place that also mean that politicians have walked the talk.
Thanks. So that's an interesting point you raise, almost as though were the US and wealthy nations to invest in helping developing nations have their own systems that could handle this information, if that's their complaint about sharing this information automatically, for example, it would be a pretty good investment, potentially, one that could help crack down on this exact tax evasion that we're talking about. So we have a small follow-up, I think, on the public country by country reporting question regarding examples of companies that voluntarily disclose their country by country tax information, as well as whether US companies will be covered by the new EU requirements. I don't know if you want to weigh in on that.
For sure, the Global Reporting Initiative has already adopted a standard. We're seeing a huge push from investors, but also from multinational corporations that they are very tired of the mistrust that has arisen because of all the tax scandals. So we are seeing more and more companies that want to voluntarily disclose their information. And as you also mentioned, Ryan, we're seeing more and more investors that want to know what they're actually investing in. This is a part of the huge momentum that we're seeing for change on this issue. So, and it goes back to the point that this discussion really looks very unstoppable at this point in the EU, and very happily also to say that it also looks very unstoppable in the United States, which we're very happy to see.
Excellent. And I think maybe we'll switch gears just a little bit based on the questions we're having. Alex, tax transparency measures and tax policy generally is often dismissed as too dense or opaque. But the state of tax justice continues to contend that these issues are human rights issues. Can you elaborate a little bit on that? And why should a working family care about beneficial ownership requirements, for example?
That's a great question. Why should they? This really goes back to kind of the beginning of the tax justice movement, you know, where there were people involved, you know, lawyers and accountants and economists and political scientists and philosophers and others, who really felt like very often in tax discussions, either there was nobody or they were the only person in the room involved in the technical negotiation of something who really cared about the social justice implications. Now, you might say tax is technical and even possibly quite boring, and therefore it doesn't really matter, right? The politics is something else, and we'll engage in politics, it'll be fine. But what you find is that if you allow the technical discussions to happen on their own with nobody in there who's thinking about the politics or the social justice, the results are not technically brilliant and politically neutral. The results are technically and politically bad. And they're bad for the same reason, because they're biased against the people who aren't there. As our great colleague Derajay Alamieho, the coordinator of the Global Alliance for Tax Justice, always says, If you're not at the table, you're on the menu. And basically that goes for people at the lower end of income distribution within countries as much as it goes for lower income countries around the world. What you're not part of ends up being against you. So look, why should you care about beneficial ownership? We know markets don't work better, they work worse when you can have anonymous ownership, when it's possible to create monopoly positions that can't be seen, when small local businesses can be outcompeted by large conglomerates taking advantage of financial secrecy, hiding who they really are to stitch up a market. We know that you get outcompeted by people who are taking advantage of secrecy to not pay their tax when you are running a good business and paying tax and trying to do the right thing in your community. So just purely from the perspective of markets, we shouldn't allow this type of anonymous ownership. But for states too, because of those tax losses, because of the way that market regulation works out less well, we end up with higher inequality, higher concentration, monopoly power. We don't get the revenues that we need to build roads, schools, hospitals, to give vaccinations, to protect us all. We end up without redistribution. So we have higher inequality from which we all suffer. People at the top and bottom end of the distribution have shorter, worse lives because of inequality. We don't have a tax system that can reprice, so we end up with carbon emissions that are too high, tobacco consumption that is bad for all of our public health. So that's 3 R's: revenue, redistribution, repricing. And the 4th R, the most important, and I think the US is an interesting case lately. When your tax system is eroded, your governance is weakened. You end up with much more exposure to corruption. When people pay tax, even though they don't like it, in fact, especially because none of us really like paying tax, even me, you hold the government to account. You feel like they're spending your money. If you don't have that link, the social contract is weakened, and we end up with governments with less revenue, spending it more corruptly, and less likely to be in the interest of all of us. Tax matters, you know, this is the state of tax justice, and we should all care because it's all of our human rights at the end of the day that matter, that give us a reason why the technical stuff needs to be considered as political.
That's a pretty rousing response. Thank you, Alex. I do think we have at least time for a couple more questions, but that's very helpful. And as the report notes, Alex, I think just to follow up on that just a little bit, one of the things the report points out is the COVID vaccine itself, the ability to pay for vaccinating the world 3 times over, correct?
That's right. I mean, you know, last year we looked at the number of nurses, you know, how many nurses' salaries are lost to tax havens every second. This year, yeah, we find you could vaccinate everyone in the world 3 times over with the money that's lost, which means, of course, that you could do a great many additional things too, just on the revenue side. And of course, with the strengthening of states and representation that brings, there's a good chance that you'd spend that money better to, you know, to give one piece of research that we have. We know that when governments rely more on tax than other sources for their own revenues, the amount that's spent on public health is bigger. But even for a given amount that's spent on public health, if more of it effectively comes from tax, that same amount of spending gives rise to public health systems that have better coverage, so they're more inclusive of people, and the health outcomes are better. Why is that? Because it's not just about revenue. It matters where the money comes from for how well it's spent. So, you know, we have the vaccine number as kind of a nice headline stat, but actually the impact is bigger and deeper than that because tax matters so much.
Thanks, Alex. I think one of the things I find so fascinating about the vaccine analogy that you use is that it highlights the exponential problem created by tax loss. When you think about the way that tax revenues could be used, not just the 5 trillion in losses over the next decade, but the fact that the failure to vaccinate could create ripple through effects throughout the economy, the global economy, which is so global now. You're talking about losses that are actually much greater potentially than $5 trillion over the next decade. And I think one other area where that's true might be climate change, which we also, as if there's not enough happening in the world, in the US and in international tax policy right now. COP26 just occurred last week. And we have the rare opportunity to have Tove on this panel, who, if folks don't know, is a bit of a climate expert as well. That's actually how she got her start before she realized that governments need the money to deal with climate change, I think is how she's told it. I'm sorry I didn't tell as well as you certainly can, but I just was curious, Tove, if you might have a response quickly on how these tax transparency measures relate to combating climate change, including in light of the recent COP26.
Yeah, thank you, Ryan. Indeed, it was very conscious that I shifted from international climate politics to tax. In short, I was quite exhausted at seeing governments sit and discuss how to find the money to solve the climate emergency. And the positive news that we have when we work on tax is that we've found hundreds of billions of dollars that get lost every year. There is broad political agreement that losing all those billions to tax havens makes absolutely no sense. But if you compare the situation that we have on vaccines, that we have on climate, and that we also have on tax, is a failure to cooperate. Our governments are failing to solve global problems because they fail to cooperate. And we see them getting stuck in speculation about whether they can get a slightly better deal than the other countries. And the result is that they're all actually coming out of there with a failed deal that doesn't tackle the problem. So we saw COP26, unfortunately, again, being stuck on the issue of finance. We have developed countries having promised to deliver 100 billion per year to developing countries. This was supposed to happen by 2020. Now they're discussing that maybe it can happen by 2023. But more fundamentally, the fear of taking on commitments to solve the problem, to do the transition to a low carbon economy, is fundamentally also a fear of having to do the public investments. And of course, tax is an answer to the problem of where do you find the resources to fund this transition. So yeah, the climate negotiations was a very, very stark reminder of why we cannot afford to continue to have a failing global tax system. It's simply too expensive for all countries. It's very sad to see. But on a positive note, linking these issues together, we can also see that the problem that we are fighting with here, if we solve it, if we make sure that multinational corporations start paying their share of tax, if we stop the situation where wealthy individuals can hide their wealth and evade taxes on such an enormous scale, we can actually start removing several of the global obstacles and solve some of the major problems that are facing our generation.
Thanks, Tove. And I think it seems kind of what you're also saying a little bit is that it goes beyond just global minimum taxes. It has very much to do with kind of the secrecy practices and the anti-cooperation practices that run counter to the ABCs of tax transparency that we're talking about, and that those are just as much needed, it seems like, to kind of address these broader problems. Is that kind of where you're?
Yeah, and it goes back to the point that Alex mentioned in the beginning, is that when companies are able to lobby the governments to sit at the table and think, well, maybe I can get the information I need and I can do a transparency that helps me, but at the same time, I can perhaps help some of my corporations still get a better tax circumstances and avoid taxes in other countries. It's these half measures. And again, the approach from we saw in the US FATCA approach, with where maybe I can get the information, but then I can avoid sending information back. And these kind of games are very sad because they basically continue this situation of the package in the end being an ineffective and opaque global tax system full of different national solutions. And the whole thing also becomes so incoherent that even multinational corporations are saying it's unworkable. They have no tax certainty, and there are too many standards pointing in all sorts of directions. So these attempts to try and play several games at once, they're basically costing us an effective, transparent, and functional global tax system. And that, at the end of the day, as Alex pointed out in the beginning, and as the State of Tax Justice report shows, that is costing us to lose hundreds of billions of dollars every year.
I don't know that we have any additional questions in the Q&A, and we're kind of winding up here, but I just wanted Alex to ask kind of, a lot's happened since the 2021, since the 2020 State of Tax Justice was released, the 2021 State of Tax Justice. It seems like so much has happened, so much hasn't happened. And I'm just curious if you have any sort of kind of high level takeaways on maybe what the US should focus on kind of as part of the ongoing slog towards tax justice.
So I think the world, we've talked a bit about it. The world is kind of watching the US at the moment on tax and thinking, how far can the Biden administration reverse some of the very damaging dynamics that have been in place? So something like investing in the IRS sends a signal to other countries about investing in their tax authorities, and the underinvestment in tax authorities is a consistent problem, really, particularly since the kind of the enriched countries, since the rise of austerity after the global financial crisis, but actually around the world, a lack of resources, a lack of independence for tax authorities. So that's key. It isn't just the international elements. There are some fundamentally important issues domestically. So I think that's somewhere where the mood music coming from the US can be very positive. But we do need to see progress too on the international cooperation, particularly the exchange of information. Whether the US can be part of a process that may be just starting to move at the G20 of saying the OECD really hasn't delivered a deal that works, and actually we're going to need to continue the negotiations. Perhaps we need to think about involving the UN or some UN bodies at least to broaden it beyond the OECD. I think if the US was to support that, that would move much more quickly. We know that we have major countries like Indonesia and India who will be the next presidents of the G20 who are very unhappy with the OECD deal. So there is a space there. But at the same time, the US has its own priorities, and having its own multinationals pay more tax elsewhere hasn't been one of them. So a question of to what extent those international concerns come into play, I think is still open. And I guess the Biden administration has its issues already in getting through its own agenda. Perhaps the one thing to look forward to a little bit is the Summit for Democracy. If that's an opportunity for President Biden to really start to deliver on his campaign pledge to lead the global fight against illicit finance, then we would expect to see some real movement on exchange of information, on beneficial ownership transparency, perhaps also on country-by-country reporting, putting the US back into some kind of a leadership role, which would be good for everyone.
Thanks, Alex. I think the takeaway that strong tax transparency reform and funding the IRS properly is essential to global democracy is, something that we certainly agree with the Fact Coalition, but something that I think can sometimes seem jarring to people who have a natural tax aversion. But this report was fantastic, and I think helps kind of show that in real terms. So thank you so much for the work, Tax Justice Network and the Global Alliance for Tax Justice and PSI for helping put together the report and for your time today. Tove, thank you so much for your time today. We know you're not at all. We know things have been very quiet for you over there with everything, but we are really appreciative to both of you for all your time and your work. And if folks have follow-up questions, please do feel free to reach out to the Fact Coalition and we'll help get those answered.
Thank you.
Thanks all.